Welcome to REI's Weekly Power Hour. I'm Neil Peterson, Editor-in-Chief of Real Estate Investor. And today's session is brought to you by REI in partnership with the Green Building Council of South Africa. And for those of you logging on now, you can maybe tell us where you're joining us from. So very quickly, who we are. REI is South Africa's leading independent award-winning property news and investment platform. And for 18 years, we've delivered daily news, a monthly magazine, weekly webinars, live events, and REI TV, clear, actionable insights for investors, landlords, and industry decision makers. And of course, a very big nod to our partners of today. It's the Green Building Council South Africa, is the country's benchmark for sustainable building. And so that's since 2007. They've set the standards, certifications, and performance frameworks that are moving our built environment from compliance to competitive advantage. So if you want to understand the green is deep, we're going to, in a deep dive to maximize investments, you're certainly in the right place. Let's go to work. So first of all, some housekeeping. We're recording today's session. The slides and the replay link will go out tomorrow morning in our newsletter, and also to those that have registered for the webinar. For our audience today, please drop your questions in the Q&A box. And of course, that's not the chat box. Some people like to play in the chat box. You say hello in the chat box, you make comments in the chat box, but you put your questions in the Q&A box. And then, of course, you can also upvote the ones you want answered first, and we will tackle them near the end of the webinar. So our topic for today is future-proof property certification, performance, and green finance. And here why this matters now. Green certification has shifted from a nice to have to a balance sheet lever. Tenants are demanding performance, lenders are pricing risk, and operating costs don't forgive inefficiency. So today we'll cut through the jargon and we'll focus on what moves the numbers. And what you'll get in the next 60 minutes is a quick scene setter from each panelist, discussions and questions around practical pathways to certification, how to fund and finance upgrades with ROI actually lands, and the pitfalls to avoid on retrofits and new builds. Quick heads up, if you want a deep dive on this topic, join us at the Green Building Convention. It's at Century City in Cape Town on the 11th to 13th of November. I will share the registration link shortly and throughout the webinar. And I advise you to come along. We'll give you more details a little bit later. But without further ado, let us introduce you to our powerhouse panelists for today. First up, we have got Lisa Reynolds. So first the introduction, Lisa, maybe just an intro about yourself. You obviously head up the Green Building Council. Maybe say hi to our audience out there.
Well, hi to the audience out there. As Neil said, I'm Lisa Reynolds. I'm the CEO of the Green Building Council. And we are in a space we are transforming the built environment into a place where people and planet thrive. And we do it by different means, certification being one of them, training being the other, and advocacy. And we'll talk more about the detail of what we do late in the podcast.
That's fantastic. Wonderful having you here, Lisa, CEO of Green Building Council, and with the upcoming Green Building Convention. Exciting times ahead and an exciting conversation ahead. We want your engagement. Lovely to have you here, Lisa. Brian Unstead, he's from Liberty Life. You can see all his details of there. Brian, introduce yourself to the audience, please.
Hi there, Neil. Thanks for the warm welcome. So I head up sustainability for one of the 4 business units within Standard Bank called it's called IAM in an acronym. It's Insurance and Asset Management. And for the purposes of today's discussion, I'll be focusing on the Liberty 2 Degrees business, which is the commercial property business line within that business unit. So I look forward to our conversation during the afternoon.
Absolutely. Great having you, Brian. And of course, last but not least, is Annalisa Kike. She's the specialist in sustainable finance. Annalisa, do you want to introduce yourself to the audience, please?
Hi, everyone. I'm Annelisa. I'm a sustainability consultant. My expertise ranges across corporate governance, sustainability, and tax. And I'm currently advising real estate companies and anyone else who has an interest in the built environment. Today, I'll be focusing on how value can be created in the sustainable finance space through your green building strategy.
Fantastic. Great having you here, Annelisa. And so we're going to get right into it because we've got a long session. And so we're getting into the Q&As. And we want your engagement and participation. Q&A box for questions. So I'm going to start off with Lisa, probably setting the standards and the reset that's happened between 2009 and 25. So Lisa, maybe you can share what are the biggest changes in the South African green building standards over the last 15 years, not 50, because you haven't been around that long. And what's next? What's next for the owners? So I'm going to share. I know you've got some slides here that you would like to also just take people through on this particular one.
Yeah. So under the Green Building Council, we were started in 2007. And we did our first building certification in 2009. And we focused on new builds. That was the focus. And when we started, we really looked at sort of the flagship type buildings that people had. And it was quite the first one was quite a process, and it was a lot of learning. So look sort of down the line, so many years later, what we realized is that we had to fill the gaps. Lots of new builds were being built, but there's a huge amount of existing buildings. So how do we look at existing buildings? And that's when we brought in the existing building performance rating tool with its support on our energy and water performer. We looked at residential, and so introduced us to the EDGE certification, and we really focused on using it. It looks at energy, water, and materials, and we looked at putting that into the residential market. And then the conversation came up, and it was around net zero. And we said, okay, in response to looking at net zero, we did net zero carbon, water, waste, and ecology. As we've gone along, and obviously the market has become more sophisticated. They know what we need to do. So when you also talk about change, it's not just about the certification. It's also about who are the players in this market. And what we've realized is that if South Africa was a signatory to the Paris Accord, which said we have to reduce carbon by X%. And if we're going to do that, we cannot just focus on the flagship and niche buildings. It really is, the new messaging is that green is for all and everybody can do it. So a part of it is also to demystify it. And I think there's a huge perception that green is expensive, where we've done research with the University of Pretoria, and we've demonstrated that to build green, there's less than a 4-star building is less than a 2% premium to build green. So what we've done is as things change, to respond to it. But now looking at the sort of whole investment side, we looked at our tools and we said, it's time to make a new tool. So we've done our new build version 2, and it's designed around what the environment, what the built environment needs now. It's got a piece where it helps with your ESG reporting. It's got a social impact section. So we've really we've designed it to correspond and respond to where we are now in the market. Because as the market has improved or become more sophisticated, as it becomes more and more mainstream, we're responding to that and trying to say, guys, this is not a huge mystery, but let's make it as user-friendly as possible.
Great. Thanks for that intro. So, Lisa, if there was one legacy practice that you would want to get rid of and retire from now, what would that be?
Neil, you've opened a can of worms here. I think it's going to sound odd, my one legacy practice is that often when people report everything, they'll put everything in the report, and at the bottom of the report, here comes sustainability. Whereas we need the thinking that sustainability is an integral part of everything. When you're looking at, even, and Annalisa knows much more about the sort of ESG reporting side and understanding it, we never want the ESG reporting to be a tick box or come at the end of something. It must be integrated into everything that you do, not like a last minute thing. If we can get everybody to sustainability first, so that everything you do, you've got that sustainability mindset. That to me would be a change in thinking and a change in legacy.
Wow. Well, that's a key point, because we need to shift that mindset over there, don't we? So that it actually climbs up the list. So Brian, we're going to bring you in over here from an owner perspective on your existing building performance journey. What has changed? And unlock the biggest improvements first. Was it metering, ops, or tenant tenant engagement rather, and why?
Yeah, thanks, Neil. I think before we climb into that detail, I'm just going to give a brief intro on the Liberty 2 Degrees portfolio and the context that I'm probably bringing to the conversation. So the Liberty 2 Degrees portfolio is a relatively small portfolio in terms of the number of assets, but high value assets, and it's very much a retail focus. So we do have some interests in other property types, but it's very much a retail focused fund, and with some highly prominent assets that include Sandton City, Nelson Mandela Square, and Eastgate in the mix. And so it's a different fund to maybe some of the other funds that have got a much more balanced portfolio across the different asset classes, etc. But that's what I'm going to bring to the conversation. So I think, in terms of looking at where to start and what the key things are, data is absolutely key. So I think metering and accurate data as part of this journey are absolutely essential, and we all get excited and we think that there's smart metering and we've got such great technology in 2025 and the world is perfect and everything balances to the T and we can account for 100% of our consumption. The reality is slightly different, and it's an ongoing challenge to make sure that you are accounting for as much of your consumption as possible. And naturally, from a financial perspective, recovering as much as we're entitled to as landlords. So there's various perspectives of why that data is important, but the data is really, really key. To have accurate data so that you can start that journey and also track that journey of tracking towards net zero, which Lisa's touched on, is absolutely critical. And then optimizing your operations is another thing. There's a lot of opportunities within the operational side. Some of them cost a lot of money, and we will touch on some of those during the afternoon. Others are minor interventions at no cost, just managing your building management systems a little bit smarter, etc. And those are opportunities we need to use.
Awesome. So Brian, if you had to show one chart to Exco, which one would it be?
For us, it would be attaining net zero waste. I think that's something we're very proud of as a portfolio. So I think that would be the one. The other net zero targets are a little bit more difficult, but we are very proud of getting that certification in early 2024. So I think we would brag with that one.
Excellent, wonderful. Okay, Annalisa, let's talk about pricing the green premium. Do lenders typically offer better terms for green or sustainability-linked bonds? Based on their links to green building certifications and or also sustainability-related KPIs.
Thanks, Neil. Look, I think the practice tends to vary. So generally, you have your green bonds, which are focused on use of proceeds. So the money that you raise through the bond, you can't just use it on whatever you want. You have to use it on a predetermined green project that has to meet the eligibility criteria that's set out in the, I know I do a lot of acronyms, but the ICMA Green Bond Principles. ICMA stands for International Capital Markets Association. And once that allocation is done, the pricing is usually set on the day that you issue the bond. And green buildings tend to be used quite frequently in the real estate sector to kind of anchor those green bonds, because another big issue is that you need to find enough assets that can make up, let's say, a 300 million rand bond or a billion rand bond, and a small collection or smattering of ESG projects won't cut it, but the market value of a green building that meets the eligibility criteria will cut it. And then, of course, you have your sustainability linked bonds. And I like to joke that with these kinds of bonds, you can do whatever you want with it. You can you buy yourself, you and the rest of the business, Lamborghinis, and you don't have to prove that you spent the money on the green project. But you do, however, need to set certain KPIs right on at the time that you issue the bond. And the key thing here is if you achieve the KPIs, you actually benefit from a lower pricing in every year that you achieve the KPIs. If you don't achieve the KPIs, you don't get a benefit in the pricing. So what we've seen is that green buildings are sometimes added as KPIs, along with the broader basket of KPIs. And usually there'll be a case of, making sure that the green building achieves a certain level of certification in order for you to see the benefit. So generally, the pricing is not super aggressive. The pricing benefit that isn't super aggressive in the bigger scheme of things. But arguably the greater benefit is that it gives the participating company access to sustainable finance capital markets, which are growing, and they certainly have grown, and the opportunities to tap new sources of capital have definitely grown over the past 5 years, and I anticipate that they'll grow even further as time goes on.
So, Annalisa, if you had to say, what minimum documentation moves credit committee from maybe to a yes?
So, it depends on how the bond is structured, but as a general rule of thumb, you'll find that your, sustainability agent or the bank that's you're talking to wants to see credible proof that this is not your first foray into sustainability. You have some sort of reliable track record, which they would look at through your sustainability reporting that Lisa mentioned earlier. And they also want to see that if you're talking about a use of proceeds green bond where we're funding a project, they want to see that you have a sufficiently large pool of assets to actually make up the bond. And if they're not comfortable that you have a sufficiently large pool of assets that is sufficiently green, so let's say for green buildings, for green star rated buildings, the typical market standard is they have to be 4-star or above. So 3-star, it's all good and well. You're doing exactly what you should do, but it doesn't necessarily mean that you now have a ticket to the game to get a bond. So they'll typically see, listen, of your assets that are certified, how many of them actually reach that 4-star level or above, or how many of them are net zero, or how many of them have some sort of sustainable building certification. And then they'll decide, on the whole, and obviously taking into account, the commercial credit metrics of the business, is it worth actually participating in the bond, or should we, as the credit committee, decide not to allow it? And generally, you find that these kinds of bonds are oversubscribed in the market because, in general, Neil, there's a lack of companies overall that have a sufficient pool of eligible assets to access this type of funding. So you have all of the big 4 banks, and Brian, you can correct me at any time about your specific bank, but you have all of the banks that have set targets as to how much sustainable finance they're going to make available to the market between now and 2030. All of them have got these targets. But that also depends on there being a sufficient number of eligible bonds that have these eligible assets underpinning them for them to actually meet those targets. So the capital is there, guys, but the question becomes, becomes, are you able to demonstrate to the credit committee is concerned that you have enough assets, or that you have, a sufficiently established ESG strategy to actually merit the bond?
I think we need to transfer Brian to the credit department at the bank. So
I'm working on them, Neil.
Great. So let's talk about.
If I can just add on what Annelies is saying, I mean,
carry on.
The numbers are staggering as well. I think Standard Bank's commitment between 2022 and 2028 is 450 billion rand towards sustainable finance funding. So it's it's significant to move the dial in terms of commitments at an industry level.
Okay, great. Awesome. Thanks for that, Brian. So, Lisa, coming back to you, when should owners choose design ratings versus operational and the EBP existing building performance ratings? What triggers a switch?
We look at new builds generally for design ratings, so it'll be so with your new build, you get as a design and an as-built rating. But once your building is operational, we believe that you must go to a performance rating. And it really does link in with sort of the sustainable investment and bonds and things like that. Because, and again, I'm going to simplify it so my co-panelists might annihilate me. But when we speak to the finance houses and the banks, we say, well, ultimately, what do you want to show out of your sustainable finance? They want to say, I need to show how much carbon is being saved from this investment that I'm putting in. It's almost that they have a responsibility to look at that there's something saved. And the one way to do it is to measure performance. So when we look at our existing building performance rating tool, it has to be renewed every 3 years, because as you know, and if you don't manage buildings properly, if you don't manage anything properly, the good performance can, be nullified. Something might happen. There may be changes. So we believe that once you've sort of got an existing building portfolio, we really need to be looking at this, because it's really, what are we maintaining it? Are we sort of committed? And I know we talk about carbon. Big thing is still water, because again, water, and water security is a major thing. It's not around the sort of sustainable finance side, but it is around what is the risk to your building if we don't have water security. So we look at those kind of things, and we need to really be measuring them and managing them. And I think that's really important. So for an asset rating, sure, get a design rating, but for performance, please keep up your existing building performance.
Okay, great. So if there's one mistake you see owners make with timing, what would that be? I
think looking at certification or looking at what they do as a one shot. The people that have been successful in the property sector that have been successful is those that, as Brian was saying, managing, metering, looking at the data, continuously, and I think consistently looking for improvement. Looking at sustainability, looking at a Green Star rating. It's not a one-hit wonder. You don't just do it and boop, there you've got it forever. It really is, and it's. Again, it's also about bringing it into your facility managers and your building managers' portfolio. Nobody wants extra work, but if we can put it into the KPIs, and that it's well managed, that it's not always a shock to the system, and it's really, really meaningful change. Okay, great. Thanks for that. So Brian, which retrofits delivered the fastest de-risk paybacks under the real OPEX pressure? I mean, we talk about controls, LEDs, solar, water, etc.
Yeah, I think the poster child of the industry is solar, and for good reason. I think if I look back over my journey in this, I started looking at solar projects probably as far back as 2012 already. And the technology was nowhere near where it is now. And I think it delivered something like a 6% 20 or 25-year IRR, whereas you should be getting 17, 18% IRRs on those same projects now. The technology has just improved so significantly. The sophistication of the industry has really, I mean, over the last 6 or 7 years, it's been incredible. And yeah, so that really is it's probably somewhat of a no-brainer, I think, for most property owners, especially where your roof is able to accommodate your solar systems and your costs of the infrastructure are reduced, where you have to put up structures, steel structures, etc. It does add quite significantly to the costs and does put those returns under a little bit of pressure. But yeah, something like LED lighting, I mean, on scale, has also been one of the greatest technological advancements I think we've seen in a long time to reduce our energy consumption. And then yeah, on the water side, I think something like, lots of small things. There's no silver bullet for most of what we're looking at. There's lots of small interventions that can make a difference. Things like tap aerators, and just going back to Lisa's point. So there's some great financial returns on some of these projects that we do. But equally as important these days is around resilience. So it's reducing your consumption or changing the nature of your supply to be able to be less dependent. I mean, especially when we were having our worst load shedding periods in 2022 and 2023, was putting the industry under a lot of pressure. But we had an outage in Sandton City at the end of 2023 for 4 days, where there was an issue on the Ilovo water system, and we had to tank in water. And I can tell you the bill was not pretty. So we've increased our tank supply. We've now got up to 4 days supply as backup. So that resilience component is really key, especially in the South African context where we are at the moment. And I agree with Lisa. I think water risks are huge, and I think we've heard it coming for a while, from the likes of Professor Turton and that, and we're experiencing it now. So we are concerned about that space. But yeah, we're doing what we can to try and mitigate as best we can.
So that would be the one retrofit you'd never repeat, or which one would it be?
The solar for me, that in terms of getting that right is just such an easy opportunity because of the way that this industry's matured, and there's a lot of credible players out there now. A couple of years ago, there was still a couple of fly-by-nighters. Suddenly, everyone was a solar salesman. But I think a lot of those people have been weeded out, and there's a lot of credibility when you go through your procurement process now in terms of who's legit and who's taking a chance.
Excellent. Great. Thanks for that, Brian. So, Annalisa, coming back to you, how should issuers set energy, water, and carbon targets for sustainability-linked SLLs, sustainability-linked loans? Really ambitious, yet achievable over 3 to 5 years. How should they do that?
Thanks, Neil. Look, I think it will depend on them ensuring that they properly understand the energy and water footprint as well as the carbon footprint of their portfolio, because they need to actually prove to potential investors that these targets are going to make some sort of recognizable difference in terms of reducing their energy consumption or supplementing their energy consumption with renewable energy as opposed to grid supplied energy, which is obviously coal fired. So they need to make sure that it is in fact stretching, and they need to prove based on a baseline that they need to set right at the time that they issue the bond that it is in fact stretching. And the other tricky part is that they need to also clearly define what portion of the portfolio the KPIs apply to. And this becomes a little bit of a tricky situation if you've got a very diverse portfolio that has properties in multiple countries. If your definition is too loose, you end up pulling, your portfolio, which is spread out through 4 or 5 different countries, into this KPI. Meanwhile, if you had actually asked someone, they would have said, oh, no, this is strictly applicable to our South African portfolio, please and thank you. So for them, it's about making sure that the parameters of the KPI are very clearly defined, and I advise every company that wants to participate in this market to do this, to make sure that their information underlying those KPIs and the testing of those KPIs is sufficiently detailed and robust. And that is something that your frontline facilities managers, property managers, utilities teams have to be clearly briefed on ahead of time, because without that, you issue the bond and it's beautiful and everybody does the photo op and you do the dance, and then you get to the measurement period and you realize that when you're dealing with an external independent assurance provider, they don't accept spreadsheets. So spreadsheets are not going to get you all the way. Interestingly, when it comes to green buildings, you usually find that the assurance providers will accept a certificate from the Green Building Council as proof. But if you're dealing with utilities, especially when you're dealing with energy, water, and so forth, you all of a sudden you realize, hang on, I need the actual municipal bills, and I need to show my work in terms of my utility service provider providing me with the proof of these different numbers. So it's worth making sure that in terms of the non-financial information that's underlying each of those targets, that information is very clearly substantiated by source level information and not just summarized on a spreadsheet. So it's entirely possible, but it's really about threading the needle when you are crafting these KPIs.
Okay, excellent. So what baseline and verification do you absolutely insist on?
Listen, so baselining, I don't know how much hair I've lost over baselining over the years, but I've managed to grow some of it back. But generally, you don't have to use a certain, let's say, year to set a baseline. You can set it, let's say, at 2019. You can set it if it's 2025 or 2024, if you so wish. But you have to make sure that the year concerned is duly representative of your entire portfolio's performance. So, earlier this decade, a lot of real estate companies that set these kinds of targets actually avoided using 2020 data, because for most of 2020, the commercial buildings were not fully active. And therefore, the data coming out of them was not fully representative of a 12-month period. Interestingly, that also kind of correlates with the Green Star existing building performance methodology, of making sure that there's sufficient occupancy and activity data during a 12-month period. So you tend to see that you need to make sure that your baseline is sufficiently robust, and you need to make sure that that the KPIs in terms of whether or not they're stretching enough are properly reckoned from the baseline, and you can justify that they are in fact going to make a difference. Because if they're a drop in the ocean, no one will buy it.
Excellent. Great. Thanks for clarifying that, Annalisa. And to Lisa, let's talk about picking the right tools. How do Green Star, Net Zero, and Edge differ in its outcomes and data demands? And how do you match tools to your business goals?
I think, look, a lot of it depends on your business goals. So we've found that in the last couple of years, Net Zero certification has become more and more on people's radars. So a lot of companies have sort of declared that by 2030 or 2035, X percentage of their portfolio must be net zero carbon. As Brian mentioned, again, he hasn't paid me. Liberty 2 has done amazing stuff on the net zero waste. I love the fact that they've also got the community involved, but that's a whole another story, because that's my favorite story to tell. And it's really about what do you want to get out of it. But if you're a newbie and you're not, this is the start of your journey. Obviously, as I said before, new builds do new builds, but then really focus on energy and water performance and existing building performance. But again, there's steps that you can do to get to it. So it's people also tend to think that it's an all or nothing. So we're saying, use the tool that gets you to where you want to go. So for instance, if you do existing building performance, you can start just with your energy and water performance if you want, because then that's your measurement. We found with Edge, as I said, we found it ideal for residential because, again, it's not a too complex market. You start with energy, water, materials. It is an asset racing, so it is almost like what we call evergreen. and it's not sort of linked on to performance. So really, it's where are you in your journey, and how can we get you to the next step? And I think that's really, it's what is your need, as a property owner or developer, is what do we want to get out of this? We'd be the last people to say, oh, you have to get 6-star rated or whatever, this and this, because that's not what it's about. It's about start. On existing building performance, you can get a 1-star rating. It's not, only when you get to 4-star rating is it recognized. But it's, again, the whole thing is, if you don't know where you're starting, how do you know where you're going to? And it is that sense of continuous improvement. So, where are you in the journey? Let the Green Building Council help you start with that, and we'll find the right tool for you for your journey.
Great. So Lisa, maybe just as an example, which tool do you think best supports lease negotiations today?
Existing building performance would be.
Okay.
Yeah.
Great. Excellent. Great. Thanks for that. Brian, let's talk about data leasing economics. What systems and clauses do you have in place to govern the relationship with tenants when it comes to sustainability matters?
Neil, there's 3 sort of key formal contracting spaces. The one is what's known as the TCD, or the Tenant Criteria Document, which determines what tenants need to do in their fit-out period. And that obviously becomes quite key for the journey of that tenant's occupation. So it needs to also comply with building compliance, but we try and push the envelope with our tenants in those tenant criteria documents that they are challenging themselves in terms of the way that they are fitting out their premises and using the best and latest technologies that are available to reduce their utilities consumption. Then we've got the actual lease agreement itself, and that's got some clauses in there that are promoting the green elements of occupancy within the premises. And then we've also got the house rules, and the house rules kind of govern during the time of the occupation how they operate within the premises, and what best practices are, etc., and how they manage their waste, as an example, to comply with our requirements as a broader business. The good thing is, I think a lot of in our space, and probably at a broader level in the industry, especially in retail, it's a lot of national tenants, and many of those national tenants have got similar challenges and opportunities around sustainability. So there's boardroom pressure on a large percentage of our tenants to move the dial within the premises that they occupy, to keep pushing the levers that they have to reduce their energy consumption, etc. So in many ways we are aligned. There's not always the same time pressures in terms of that alignment. Some of the companies are more advanced. We find, particularly with a lot of the international brands, their level of thinking is quite advanced, and they've been on this journey for a little bit longer than some of our local brands. But we've been really encouraged by our engagement with most of our local tenants as well, in terms of the commitment to participate in this journey, and the pressures that they do have. And we've seen, like when we work towards the net zero waste program, the beginning was quite difficult. There was a lot of awkward conversations around what needed to change from previous practices. And as that journey progressed, and we went as a business from, say, 35% diversion from landfill up to 90%, and tenants were recognized in that process, and they felt quite a sense of pride of being part of that process, and that was quite rewarding. So it is that resistance to change from the way that things have been done, but once you get on that journey, I think there's a huge sense of reward for both landlord and tenant.
Excellent. Great. Thanks for clarifying that, Brian. And Elisa, what documentation trail convinces investors that the stated objectives of a green or sustainability linked bond, SLB, has been achieved?
Sure. So in terms of the ICMA Green Bond Principles, once again, International Capital Markets Association of Green Bond Principles, you need to have some sort of reporting at the end of the first 12-month period after the bond was issued that proves, either the performance of the assets, in the case of the use of proceeds. And generally the important part, and that's where you now need to get your independent, third party to come in and actually do an assurance exercise, is for those green bonds to prove that the money that was supposed to be allocated to those eligible projects was in fact allocated to those eligible projects. If you need a little bit more time to select them, you do have 24 months of the date that the bond was issued to do that, but you need to then prove that the money that was raised is somehow ring-fenced from an accounting perspective. So it's not just mixed up, with all of the other working capital of the business. Then you have your sustainability linked bond, in terms of which now you're measuring performance against KPIs. So typically you would need to publish a record of whether or not each of those key performance indicators were met and the extent to which they were met. And whether or not this affects the pricing. So for example, if on day one you decided I'm going to have 3 KPIs, and if I meet all 3 KPIs, then I get a pricing benefit. You essentially have to show that there's an independent assurance provider that has confirmed that yes, in fact, you either met or you didn't meet the targets and the extent to which you didn't. So generally, these kinds of proof of how the money was used in the case of the green bond, or whether or not the targets were achieved in the case of the sustainability-linked bond, needs to be published to your investors. So if you've negotiated a one-on-one bond, that needs to be distributed to the private bond holders. And if it was a public bond, which is now being traded on the JSE sustainability debt segment, you need to actually publish that on your website, so that all and sundry, or all of your bondholders are able to see the extent to which you've actually either allocated the proceeds of the bond, in the case of the green bond, or you've met the targets in the case of the sustainability-linked bond. But that assurance element is absolutely critical. There's a useful principle behind that, in that if you're going to link green to your bond or your loan and so forth, the investors aren't just going to rely on your say-so. And the ICMA principles are designed to make sure that the investors get some sort of credible proof beyond just your say-so that you have in fact done what you said you are going to do in terms of furthering environmental objectives.
Great. Thanks for that, Annalisa. And last round before we get into our questions for our audience. So Lisa, let's talk a little bit about governance. How should boards govern performance, post-certification, KPIs, audits, cadence, even incentives and consequence management?
Well, I always say my life is made up of carrots, sticks, and tambourines, every now and then. So we have that. And I think that is what it is. What we've seen through the research, through the MSCI data, and whether it be the University of Pretoria research or just the general application implementation of green principles, they've all got a value it's a bottom line saving, whether it be water, energy, waste. And I think it makes business sense to put these into people's KPIs and to say, and as I said before, it has to be managed. It has to be a sense of continuous management, and not the sense of, this is now a task I have to add on top of my work. Whereas the rewards that you get for it are financial rewards. Some people, we find we can talk about, saving the planet and climate change and all that. But sometimes we just talk about bottom line. Like, what would this cost you if you didn't do it? What would the risk to be would be if we don't do it? And I think that's the thing is again, not putting it on as an add-on, putting it on as, look, this is the way we run the business. We run it sustainably. We meter things. We get instant notification if there's a water leak. We get instant notification if something's gone wrong with the energy supply. And I think that kind of management throughout it's got savings. So therefore, if you're not taking opportunity of making savings, you're wasting money. And obviously there should be consequences. And I think that's the thing is, when we look at sort of the board of directors, generally they understand that, look, this makes financial sense. And it does not make financial sense not to do it. And, we also look, we're talking about resilience and future proofing. If you don't do these things now, what is the legacy of your building? Buildings are around 30 to 50 years. If they're not run well, where are they going to be in 30 years' time? If they're not resilient to the climate change, what do you have to do to make it resilient? And it's going to involve costs, the risk of stranded assets, and all those good things. So it's really, if it's really taking the business case and saying, with anything, how do I ensure that this carries through the organization, and that we celebrate the successes, we incentivize the good stuff, and if people don't manage it, obviously the normal rules apply.
The question is, who actually owns that dashboard?
I would love it to be owned by, the C-suite, so that they know. But often it's to a sort of sustainability manager or the facilities manager and things like that. But obviously, there'll be a sustainable. Most places like a sustainability office or environmental people that are responsible for the ESG reporting. But obviously, first prize is that from top, they understand this has to happen because it's led from the top.
Absolutely.
And it's obviously you delegate management down the line, but it should be vital to your running of the business.
Wonderful. Great. Thanks for clarifying that. Brian, so what mistakes should owners avoid when scaling ratings? If you want to move, say, like from 4 to 5, is it overreach? Is it under measurement, copy, paste specs, maybe misaligned incentives?
Yeah, there's a couple. I think the first one is around resourcing. So what's important to you as a team, you're competing against other capital allocations, so you need to be realistic. You also need to be realistic in terms of how much your team can actually deliver. Getting capital is one thing, actually executing projects and completing them is another. Tempering expectations in terms of returns as well. I think always keep a bit of a buffer and don't overstretch in terms of what the returns are, because there are often surprises on projects. So just keep a little bit in the back pocket to make sure that you can achieve what you're committing to. And then target dates. Again, things can and often do go wrong. So just try and temper expectations in terms of delivery as well. And then, copy paste doesn't work. I mean, the age of different buildings is a significant factor in terms of your ability to achieve points on the rating scale on a Green Star rating, for example. So one of those factors is around your proximity to public transport, and that's not so easy to change. So there's different ways of moving the dial, but definitely a copy paste approach would not be something that I would recommend. And then not forgetting about the other considerations of Green Star ratings. The obvious ones around energy, water, and waste, and then what I would call the more administrative components of it around building occupants, user guides, and green leases, and those kind of components. But then the third big bucket that I would classify is around occupant well-being. And those are really important. So access to lighting facilities and glare on people's computer screens and noise levels and all of those hygiene factors, which are really, really important. And I think we especially realized that during COVID, when something like your state of your air conditioning filters and that may not have been a big issue in 2019. I promise you in 2020, everyone wanted to know what the state of the filters and the air conditioning systems were like, and that they they were breathing fresh air and hopefully had access to opening windows, etc. So those occupant well-being, at the end of the day, we all in buildings for a reason, and the people in those buildings need to be well looked after, whether it's a retail facility, whether it's an office facility, an industrial facility. Those are really, really important things that we sometimes tend to neglect in the rating process, but are incredibly important. So I would just caution people about not recognizing those in the process.
Okay, great. Thanks for that. I want to move to the final question, Annalisa, before we get to the questions, because all of a sudden we've got a pile of questions, and there's some really technical ones over here, which we'd like to deal with. But Annalisa, let's just talk about infinality standards that can unlock capital. Here's some questions related to that we'll deal with now. But how do IDS, and without me saying international disclosure standards, for example, the IFRS Sustainability Disclosure Standard, interact with and can support green finance? Annalisa?
Thanks, Neil. And look, when you said IDS, I was like, there's a portion of the... Sorry, can you hear me?
Yes, hello? Okay. Yep. Yes, absolutely. Okay. Yep.
So when you said, IDS, I was like, oh no, there's an acronym. I don't know. How is this possible?
International Disclosure Standards, just to clarify.
Yes. So when it comes to the different disclosure standards, one should always use them to the extent that they are useful. So the IFRS, Sustainability Disclosure Standards, that is issued by the IFRS Foundation. They're the guys who issue the accounting standards. And that standard essentially is carved into two parts. And it essentially says that if you want to adhere to the standard, you need to disclose, the sustainability-related risks and opportunities. You notice how it talks about and opportunities. And a lot of real estate companies have got risk management, but they don't have opportunities. So we're talking risks and opportunities that can affect the financial prospects of the company that are useful to primary users of financial reports, that's investors and funders, in the short, medium, and long term. And arguably, your ability to access sustainable finance capital markets could count as a significant opportunity in the sense that you're then able to diversify your pool of funders. It's never a good idea for negotiation purposes to be beholden to, one or two banks. Ideally, you should have a number of funders that you can use to manage your debt as a real estate company. And so that opportunity becomes quite good. Yes, the lower cost of the bond in terms of the pricing benefit can also be counted as something that could be quite useful to investors and funders, and could definitely boost your reporting. But even in terms of the risk part, and I haven't spoken about this much, but there is a risk associated with your ability as a real estate company to access regular capital markets in the future. So as the market shifts and the idea that all buildings should have some sort of green performance, associated with them, and that should be transparent, as the market shifts, we're probably, and once again, maybe Brian will correct me, in the chat, but you're probably going to see more and more banks saying, listen, this is a normal transaction. It's got no green in it, but we need to decarbonize. We need to disclose our financed emissions, and we need to show that we're decarbonizing. And you as our client need to be part of that. So green or no green, green bond, no green bond, sustainability-linked bond, no sustainability-linked bond, clear all the jargon, as a precondition to us refinancing you or financing you, we need to see that you have some sort of credible green performance element associated with the buildings that you want us to finance, or even the portfolio you want us to finance. So over time, I think that is going to be a significant risk. It's probably more long-term than anything. And we certainly see that in the European Union, where they've got very stringent regulations, and the European Union banks are saying, if this building is what's classified as a brown building in the regulations, we're not going to touch it. find someone else to refinance it. So over time, I think the market might start shifting in that direction, which I think could be a risk that we'd need to disclose in terms of these different reporting frameworks. Thanks.
Great stuff. Thanks very much for clarifying that, Annalisa. Okay, we've got a bunch of questions here. We've got about 9 questions, some easy ones and some really complex ones. The first one is for you, Lisa, and it's regarding EDGE certification implementation currently in South Africa. Is it a standard for residential buildings now? And furthermore, how does that impact market value of rental apartments?
Okay, all of our certifications are voluntary, so them are standards. They are energy efficiency regulations and standards for buildings. That obviously, that's a conditional requirement. You must comply with law before you go to certification. So on EDGE, we look at you have to demonstrate a 20% improvement in energy, water, and materials to get EDGE certified. So it's not standard, it's above. You have to do more. There are a lot of banks give eco loans for certified projects, and obviously EDGE certified projects. And I'm not sure about the rental market. I know that a homeowner will get a better bond rate for purchasing a green property or a certified property, but I have not really looked at the rental market. I really don't know.
Yeah, it's quite specific, but yeah, I wouldn't think it's probably that advanced in that particular sector. But you are certainly rate residential buildings. Yeah. Great, thanks for that, Lisa. So another one I think it's for you, Annalisa, because it is from Anonymous. Given the concept of additionality, do you think that equity and debt providers will start requiring that owners show that the assets are either still green or performing in a way that is green? Annalisa, are you the right one for that? Are you comfortable on that one?
Yeah, I can tackle that. So maybe for the audience, I'll very briefly and high level explain additionality. Additionality is the concept that if I want to finance a green project as a bank, I am not going to finance a project that you would have done anyway in the course of business. You have to prove that had it not been for this project, either your carbon footprint would have been higher or your water footprint would have been higher and so forth. So you need to show that as a result of the project, there's been some sort of discernible and measurable green benefits. And if you can't prove that additionality, because this is just a regular run-of-the-mill project that I would have done in the ordinary course of business, and I can't prove that I would have had an additional, let's say, energy saving or water saving, then it doesn't count. And generally speaking, I think if I look at that question, I do think that over time, owners will probably need to start demonstrating that performance element. I think Lisa touched on this earlier as well. At the moment, I'll play open cards. At the moment, I think a lot of the market still accepts that if you rate a building when it was designed and the rating itself is evergreen, then that's the end of the case. Case closed. And there's still very much that attitude that, I get a 4-star rating or 5-star rating when I design this building and therefore it's good to go. But I do think that over time, we'll probably start shifting away from that mindset. Why? Because, the building's lifespan, as Lisa mentioned, can be 30 years. I think the Royal Institute of Chartered Surveyors is saying that the average is 60 years. And you cannot possibly guarantee that the performance of the building is going to stay at the level that it was designed for way back in 2019. You know, if we're talking about, let's say, 2040 or even 2030 outcomes, because you have to factor in the fact that occupancy changes. People might, decide to turn it, let's say, from a single tenanted building to a multi-tenanted building, and that brings a host of changes in terms of how the building is now performing from an environmental and even a social perspective. So certainly, I think that over time, we'll probably move away from this idea of once green, always green, as long as I got it right when it was designed. And we'll start moving towards, a world where people say, yes, I understand and I acknowledge that you got this right when it was designed, but please give me current performance data and please give me some sort of credible proof that you are, in fact, over time maintaining the modeled green performance of this building.
Great, thanks for that. Brian, do you know if Standard Bank has given criteria to what type of projects would gain access to the sustainable finance they wish to issue?
It's very strict. So I won't have time to go into the detail of that now, but there's very strict criteria in terms of the bucketing of those allocations that will be verified by external second-party opinion providers in terms of those allocations.
Okay, great. Thanks for keeping that short, Brian. So I'm going to run through all the questions, and I would like, whoever, just to run through it quickly. For those of you who want to know more, come and join us at the Green Building Council Convention from the 11th to the 13th of November. It's going to be in Cape Town at Century City. We'll send everybody a link. I encourage you all to be there. I know there's been just an announcement. I think it's the ministers, the Honorary Dean McPherson, he's agreed to be there, Department of Public Works. So please come and join us. Please network, interact. It really is 3-day if you want to learn about this particular this category, which is such an important growing and for the future of our property in this country. So please join us there. So on that one, I'm going to bring you in, Elisa. Maybe keep it quite short before we get to our final wrap. I want to just touch on each of the questions if we can, briefly, and we can always elaborate a little bit later. I know it's already tough with the time, but Annalisa, how do we bring the Bakkie contractors to access funding in the sector for repurposing property, particularly in the townships, and also underutilized properties, from practical application, certification, financing? And I know it's a tough call. What are your thoughts on that?
Look, it is a tough call. I would advise that you get in touch with whoever's providing you with finance. I mean, all of the banks have got very sophisticated, sustainable finance teams, and ask, your regular contact person, can I get in touch with these guys? Because, on its face, the description sounds like, you could have the makings of a solid, social bond or socially linked bond. But once again, and this is where I'd encourage you to do the background research as well and start gathering the evidence. You would need to prove who are the beneficiaries of these initiatives? How many of them are there? Why should they be beneficiaries? So explaining why, the township economy is very different to the economy of the Sandton CBD. It sounds like everyone should know, but especially in a situation where you're dealing with non-South Africans, they sometimes don't know. So I would say, ask your regular, finance contact, and you put me in touch with the sustainable finance team. Please, let's start talking about it. I will warn you in advance. There's going to be a lot of documentation required, which is why I'm saying even the receipts in terms of the Bakkies, etc., keep those receipts with you.
Okay, cool. Great for that. We just lost your last bit there, Annalisa. You accidentally went on to mute, but it's not a problem. Please reach out. And I would like to say to everybody, if you'd like to reach out, you can reach out either directly to info@REI. We'll make sure all the panelists get any of the queries through there. They will be in touch with you. We'll ensure their team gets in touch with you. Brian, I just want to ask you, there's a question to you. What are the minimum size projects that Standard Bank will invest in?
I couldn't answer that offhand. I'd need to refer back to
go to finance. Okay. All right. So now I see it's a bit of a long question from Kim Murray Eads. Now, Kim, what I'm going to suggest, and maybe Brian, I think it is for you, unless you would like to answer, I would suggest that you reach out directly to Brian. I'm happy to connect the two of you. So Brian, if we can connect that, I think, because I'm just conscious of time. We're a little bit over time now, and I would like to wrap up. So what I would like to do is just to go around to each of our panelists, starting with the CEO of Green Building Council, Lisa, to give us your final thoughts, your parting shots. Maybe 1 minute takeaway for landlords and building owners.
Well, as you know, a good brand says, just do it. I think, again, we've gone through the sort of financial side, the benefit side. One thing I wanted to add to Annalisa's comments is a lot of the banks also look at SMMEs with special light. And so there's opportunities to do different things. And I think it's really, it makes business sense. It's, you can all control your own space. It's not complicated. There's wellness as well in it, as Brian mentioned. And I think it's really, whatever you believe the challenges are, they're not as big as you think they are, whether it be finance or cost of green or, wow, I can't, I couldn't do this. I think really it's accessible, you can do it, and it really makes sense to do it. And the bigger picture is obviously we're feeling the effects of climate change. Let's try and do our bit to mitigate those things.
Excellent. Great. And on that note, I'd like to thank you. That's Lisa Reynolds. She is the CEO of the Green Building Council. Please join us on the 11th to the 13th of November. There's still a lot of you here that are still on the webinar. You haven't run away yet, which is good news. So, Brian, your parting shots and your closing thoughts to the audience, please.
Thanks, Neil. I think from my perspective, I'm just really grateful to be working in the South African context. I think you're seeing what's happening in America, the pressures that's happening in the sustainability space there. And certainly as an organization, Standard Bank is fully committed to this journey. And I'm just really grateful to be part of this. And it's an amazing group of people, an industry that's grown and matured over the last 15 years, sort of from the time that the GBCSA started. And look forward to hopefully seeing lots of people at the conference. There's my last punt.
Absolutely. No, excellent. Well, that's what it's all about, isn't it? So if you're really serious about this topic, and I suggest get there, not only will you have lots of fun, it's great networking, and I mean, the quality of speakers really to get up to date with what's happening green in South Africa and the world. So last but not least, Annalisa, your final thoughts and parting shots to everybody, please.
Thanks so much, Neil. This has been great. I think, accessing sustainable finance markets, it is tricky. Don't rush into it headlong, because there's a big difference between some light marketing on ESG and actually linking finance to ESG. The standard of quality and transparency required is something completely different to having a brochure or two. But once again, I mean, maybe echoing Lisa's sentiment as well, it's entirely doable. You need to plan in advance. You need to plan carefully. You need to probably to do away with the spreadsheets of death and have some real credible data, but it is entirely doable. Thanks a lot.
Wonderful. That's Annalisa Keki. She is a finance consultant. So thank you very much. And to everybody here, 2 quick things before we close. Join us at the Green Building Council. That's right. From the 11th to the 13th of November, Century City, Cape Town. The theme is Stepping Up to Next. So as we mentioned, the Minister of Public Works will be there, Michael Paul Lane and Dr. Anika Akinsemolu. Not bad, eh? And you just register. There is a link which will be dropped. It's already there in the chat box. We will let you know also through when we send you a recording. So there will be a recording of this webinar. For those of REI who would like to join us for our next webinar, it's actually going to be next Tuesday at 7 o'clock, Avoiding the Distressed Investor Trap, with special guest Renee Crick of Sentinel Homes. So there is a link there to book, or you just go to the rei.co.za website. To everybody on our panel, to the Green Building Council South Africa, and to Standard Bank Liberty, to Annalisa, to the team, it's been a wonderful discussion. And to all of you, thank you for all your sharp questions you sent today. For those that didn't get the questions answered, we're going to connect you up with the experts, the relevant experts, and we will supply you with the details that you can reach out to each other and take it from there. So, ladies and gentlemen, in closing, this is Neil Peterson, and we'll see you next Tuesday alongside the team from the Green Building Council. We'll see you then.